Right, guys. Hi. Sorry, I was actually interrupted. My class was interrupted, which is why I have a chapter 9, part 1. I really want to continue, but I had to stop. So that was what I finished roughly at about talking about asset turnover, and the main points here. The other thing about asset turnover to understand, again, like I said here, is that we're talking about turnover um, divided by capital in, if you like, capital employed. Now, it's important to understand that because you have this kind of scenario where you have um, profitability, profitability times um, productivity. When you invest in new machinery, it'll take a while for that machinery to start really generating the profits you're interested in, if you like, or you're trying to gain. So return on capital employed can dip, but it's important to recognize that if the dip is because you have just recently, if you like, invested new assets into the making of this product, then that's okay. It's important to understand that it's not always negative, because typically a fall in return on capital employed is seen as a negative sort of indicator of performance. So I think it's important to sort of pick up on that. So the final one here, of course, is the gross profit margin, which is literally just gross profit divided by turnover. So literally saying how much of our revenue are we keeping for ourselves, and we're really looking at that. And of course, you can compare that from one year to the next. In this case, it is the same thing. If you want to improve this, of course, you're thinking about how do you improve pricing. Of course, how do you improve your pricing, or how do you reduce your costs with your suppliers, or how do you change your sales mix? Probably is another option. Okay, great stuff. So the next issue we're going to be banging on about is liquidity. We did this at financial statements. Liquidity is very much looking at our short-term assets and our short-term liabilities, and how well we're manipulating and using these to generate profit. So in terms of buying stock, selling the stock, getting the money back, paying our suppliers, that kind of cycle is what we're really looking at. And we can first of all just assess, are we able to meet our short-term liabilities? That's the first general idea, which is why we perform this calculation, looking at the current ratio, which is current assets divided by current liabilities. And of course, we would like our current assets to be greater than our current liabilities. Remember that your current assets are made up of um, current assets are made up of bank, if you like, trade receivables, trade receivables, and inventory. So yes, we want our current assets to be greater, but we don't want it packed full of inventory, because this is the potential here is that inventory can get obsolete, and neither do we want it packed with trade receivables, if you like, or that are too high, because of course there's the risk that we may not receive the money. So yes, we do want it to be high, or we want a situation where we can be sure that we can actually even meet our liabilities, because when you pay your liabilities, you tend to pay them out of bank. So just because you have a positive current ratio in itself is not a safety net. You want to spend time looking at your quick ratio, which is excluding inventory from this list of current assets, to see how much of your trade receivables and bank you have available to meet your current liabilities. And then, of course, you can do those calculations there as well. Again, like I said here, the point here is that we are trying our best to make sure we have enough to assess how much cash we have in order to meet our short-term um, liabilities. That's really the point. So how quickly you are getting your money from your, well, to support this, we're going to look at a few more ratios. How quickly we are turning over stock, how quickly we're getting our money from our customers, and how quickly we have to pay our suppliers. Which brings us, if you like, to this idea of other working capital ratios. And the first one we look at to remind ourselves, of course, is the inventory holding days. This is how long we're holding our inventory. So, of course, the longer you hold your inventory for, there's a greater risk. So the whole idea here is assessing, comparing to the industry, comparing year to year. Longer holding of inventory would lead likely to theft, obsolescence, damage, going out of fashion. So of course we might not have to write that down in terms of that we're looking at a fall, a loss in value of assets, literally. Um, and the same thing, but these are percentages, right? So you have here inventories divided by costs. What percentage of your cost of sales are you holding by the end of the year? That's really what we're fundamentally asking, but not as a percentage, which is why you kind of see this 365% thing going on here. But the point really is that really as a percentage of all the goods you've bought in the year, what percentage are you still holding? Um, then we now have the trade receivables. So really, for all the credit revenue you have received, all the revenue you have sold because you've sold on credit, what percentage of that are you still owed? This is what's really happening here. What percentage of that are you still owed? And of course, it goes without saying that you don't want that high at all. You want to be able to get your money as soon as possible. Trade payable being the same thing. Um, trade payable as a percentage of you're buying goods on credit. What percentage are you owing, if you like, at the end of the period? And so we calculate these again using those ratios and comparing from one year to the next. And so I would work through these examples. Um, Again, here you can see what they've done is to calculate all the ratios. I mean, again, this is a revision. You should be fine. Please definitely do walk through and ping out all these calculations. We have been through this, and then yeah. So again, what we are fundamentally trying to do is to compare one year with the next, or um, compare similar companies in the same industry. And that's kind of a one way to see it, to really understand how well, if you like, a business is doing. Then we come to this idea of scenario planning, where we can carry out what's referred to as what if analysis. And fundamentally, here we can alter and sort of say it's in a way it's a bit like creating an idea of a flexible budget. What if we produced 20,000 units rather than 15,000? How would that affect revenue, and how would that affect sales? And you are literally applying that. What if price was to increase by 15%? How would that increase, affect revenue, and how would that affect if price was to increase by 15%, and if cost of sales were to increase by 10%, calculate. So if you're using Excel, this is all pretty straight. You're just kind of recalculating using the new figures, and you can then calculate to see what the differences would be when you have the revised calculations. Right. So in terms of manufacturing, which is where we are, in terms of efficiency and measuring looking at these issues in terms of performance, you have to be quite specific to certain industries. You want to see how efficient are things going. Of course, we have been looking, if you like, at a number of things. So, for example, how many units? This is a classic one. How many units have been produced, if you like, per hour, per labor hour, if you like. That's probably your greatest, if you like, productive hours to total hours paid, actual output to full capacity output. So are we totally utilizing, so we talked a while ago about fixed overhead capacity variances. This is one of those scenarios where we're asking the question that these overheads that we're buying, or this space we're buying, are we using it efficiently as we can? We can also calculate, of course, sales unit per person. Um, you can see they're really trying to come up with a number of avenues for you to assess. But of course, we are trying our best to, of course, relate this to it'll be strongly related to the industry, or to the scenario that you're dealing with, if you like, in measuring efficiency and resource utilization. So again, here you can see here that you can kind of look at these ratios. If you're looking at activity ratios, there's three ratios we have here: activity, capacity, and efficiency. So in terms of activity, what we're really asking here is that you measure, in terms of activity, um, based on in standard hours, of course. Look at actual output measured in standard hours, divided by your budgeted production hours. So that gives you a way of measuring, to see how well what your output is in effect. in effect. And capacity, if you like, your actual hours divided by your budgeted hours, and efficiency, actual output measured in standard hours divided by actual production in hours. And you can see here, applying these, you can then go through and punch out these hours. So this is yeah, an area that you should just spend some time focusing on and looking at in terms of trying to work out those ratios, work out those ratios over there. Um, so here we look at value, this question of value added here, and value added literally is just what addition or what more are we having, if you like, what additional creation of wealth are we seeing in the period. So it tends to be a very value kind of public sector type of language here with value added, and just sort of seeing how that works here. He says you have here value added statement. You have revenue here, for example, 1.35. You bring in. It's really like just get everything and let's see what we've added. In terms of, it's almost like a fancy term for profit. You bring in some raw materials, so great stuff. So you've now added, if you like, to these raw materials. Well, what happened was you bought in these raw materials, and for you to be able to sell it for 1.35, you must have added, if you like, some value of £0.80, if you like. So you can think of it like that. So you added value of £0.80. Now, in order to have gotten there, these were the costs, if you like, to get there, right? The actual work done on it. So the costs, you paid employees, you paid dividends, did all those costs. And if you take those costs from what you actually added, because that's the raw material, you sold it for this, that's the value added. If you like, less, if you like, all the costs, technically gives you what's referred to as your retained profit. So if you know what your value added is, and you had, for example, you have, it says here that you have 20 employees, you can almost kind of find what your value added is per employee, or your value added per employee costs. The key point is you can basically do value added per whatever it is you're doing if you just want to know. And the value added is literally the difference between your revenue and your original starting raw material cost, in effect. And that's a nice kind of another way of looking at things. Lots of ideas around measuring resource utilization. So in terms of utilization, trying to measure how well you've done, you can be looking at how well you're using your machines, what the idle time is, trying to assess wastage, turnover, same thing, absenteeism, idle time. So you're looking for what the normals are and to sort of compare. So lots of ways of measuring or finding things to measure to see how well you're doing in terms of the use of these raw materials. But again, they are subjective, and you have to kind of, when I say subjective, they are unique to the scenario you're given. So you're looking and being creative with what you're given. And again, like I say, we're just looking at performance. You have staff, you want to see how fast they are, how kind they are, customer services, uh, fall in waiting times, that sort of thing. So typically you can give people a questionnaire to fill out a survey if you like to see how they're doing. There are other things we also tend to look at, and we'll see something called the balance scorecard in a second. But there are other things we're looking at. We're looking at new products. So when you have your staff coming up with new products or improvements, that is growth and that's performance. That's another way of performing. So again, like I say here, viable new products to existing products. Total profits, looking at the profitability on each of these new products. So your staff are actually developing things and growing. And flexibility, so the ability to respond to different customer situations and markets and economic situation, is also a measure of performance. All of this will feed into the final profitability that we see. Right. So I know that a lot of what we've been talking about seems quite production based, but also in the service department, we can find ways of measuring performance, if you like, in terms of costs. Some of the examples here, if you like, are sort of running costs per van mile or cost per call out. If you're managing people, those are some examples there. So here's a little example here. It says, yeah, consider a transport distribution department. What type of cost performance indicators might be appropriate? You can see here a range of things here. You might be looking at their wages, of course, the admin, if you like, costs involved in managing these people, what insurance costs, any extra fines, road tax. A lot of these will be standard. But then, of course, in terms of running costs, repairs, maintenance, fuel, right? So these are all costs that you can assess even in a service in the service sector. And of course, understanding the behavior will help you, um, if you like, manage those costs. And when we talk about the service sector, we have everything from, of course, professional services like accountants and lawyers, if you like, to public sector sort of thing. Right. And of course, again, the indicators will, of course, all depend, of course, on what you are dealing with, of course, and what type of organization you're looking at here. Um, yeah, I think a lot of this is very sort of general, and I think until we apply all of this in a question when you start doing the questions, but a lot of it is kind of applied, like I say, to the question. But you are still fundamentally looking at performance measures where you can with finance, and of course looking at costs, whether it is you're looking to do with people and um, lateness or sickness, absenteeism. These are all the sorts of things you're looking at to see how you can measure how well they're doing. So, for example, here you can see here it says a transport company is reviewing the way it reports vehicle operating costs and management. It's looking for performance ratios, which will help to assess efficiency and effectiveness. So they've got a certain number of costs here, if you like, um, general costs, and then they have a range of activities. So they're looking for suitable performance ratios which can be used to measure that. So they want to look at three of the ratios should look at efficient use of costs and efficient use of vehicles. So you can see here you have these costs here, these sort of fixed costs, and you actually have costs relating to the vehicles as well to the so again here if you're looking at costs, you're looking at in terms of these costs per something in either the mile or the ton carried or per journey, that sort of thing. um, and again, like I said here, you could also be assessing how many tons are being carried a day, how many journeys have been made. Think of a delivery driver, if you like, how many days, how many deliveries are being done in a day, how much time is spent per each delivery. You're just reacting to the question, and you can, if you like, find some kind of middle ground here. Um, and that's kind of the point here. Days used as a percentage of available days. So in terms of just absenteeism and that sort of thing. So maintenance costs of the car in a week, something along those lines. So please, yes, have a go at TYU1. These are all very good, and have a look at these. And these allow you to actually go through and spend some time um, reacting to the question. Like I say, it's all about looking at the question and trying to get into the question. So please spend some time on TYU1. We will see similar things in the exam kit, and we will do a lot of these when we're doing the at revision. At revision. Okay, great. So I think it's important to just go through the theory now and make sure you're comfortable. So again here, lots of other things here in terms of measuring. You can see that here if you're at a college or a service sector, measures pass rates. This is, for example, you're at a college or something along those lines. Friendliness, access, facilities, all that. He says you can no doubt think of some more factors. So you can see the reason I'm breezing through is because you can be creative with a lot of these if you're looking for ways to measure how well people are doing. So, and I would say the same thing, kind of go through these and look out for that kind of that creativity of how to make things to measure, to look for costs, performances that you can measure. So total quality management, if you like, is referred to as this continuous improvement, TQM. You're constantly improving things and trying to eliminate waste and trying to minimize the holding of inventory and trying to educate your personnel and trying to get them, if you like, skilled up and to get it right to minimize zero defects. And that's what this is very much about. So this is a classic case of just-in-time production where we don't want to keep any inventory and we only want to make sure we react to orders, and deliver when we need the product. Oh, sorry, when our client asks or demands the product, and we almost get in the raw materials almost immediately. And it means that to have this, everyone needs to be involved. Um, and so they have this idea of what they refer to as quality circles, if you like. So every employee is involved and they're constantly talking about how to improve quality and improve ideas. So they have these quality circles. And so they have constantly discussing and putting forward ideas as to how to reduce waste and if you like, yeah, pretty much keeping quality there as high up there. So again, constantly evaluating where you have any issues or failure costs, whatever it is. The point really is that you are constantly assessing all the things that can bring you potential loss and making sure that they don't happen again by involving everyone. So you can see a series of options. So you have failure costs, here you have appraisal costs, if you like. So these are the costs of monitoring, um, quality inspections, and quality audits. So these are the kinds of things that you're going to see a bit more of when you are in a total quality management environment. Um, and of course, you're trying to prevent um, these defects, if you like. Quality circles that we've just talked about being one of them. Education and training, um, customer survey, trying to improve, like I say, the quality of the product. The balance scorecard, very interesting. Balance scorecard says, listen, if we really truly want to improve performance, we shouldn't just be looking at the finance. We should look at what drives the finance, right? And it tells you this: learning and growth. Um, tells you there's the internal process, and there is um, customer satisfaction. Ultimately, that if you can improve these three things, you will improve your finance. So it looks for ways of measuring learning and growth and measuring how well your internal process is. And what is your internal process? It's saying, just the way Amazon, you put an order on Amazon, and how quickly uh, from we go from order to delivery, and that's the internal process, that everything from all the procurement to getting it through the system to getting it to the client, how the value chain in effect, how quickly does a product go from order to delivery, and of course customer satisfaction. So that's kind of the argument here. You can sort of see that this is the business process: time to market, organizational learning. We've just been talking about TQM. Are we improving? Are we learning? What's the learning growth like? And are customers happy? In terms of, our customers happy with our product? And if you do all these things, then you will see an improvement in profitability, in revenue growth, and in all of these areas. So it's telling you that if you want to measure those things, if you want to improve, forgive me, those things here, you are trying to. These are the things you need to do to kind of succeed, if you like, in those areas. So state of the art processing plant, if you like state of the art systems, if you like, that can track the goods, if you like. And in terms of learning and growth, you want to be bringing new products through the system. You can see here that it's the people who work in the system, learning and growth. Here we are: organizational learning, continuous improvement, program success. People who live in the program, who work in the program, who will be able to bring change and improvement to the program. And I think that's kind of the main point here. We're constantly trying to control costs to increase value, right? Ultimately, that's kind of the point here. How do we constantly improve our systems to add value and, of course, reduce costs, so that we can truly have that kind of growth and profit that we are looking for. And so you see businesses have to be very clear about how they will go about ensuring that they are, um, if you like, managing these costs. Um, you can see a number. I mean, this is all quite general theory, general reading theory, but clear objectives as to how we're going to minimize our costs and do better um, over the period. Now, target costing is an interesting one. Target costing literally says that, listen, this is if you're selling this for £100, we definitely want you to come back with a profit of 20%. So you have to come back with a profit of £20, which means that the costs have to be 80. If you're currently spending £89, you need to find a way to knock a nine off. That's target costing. So it's to do with the cost to satisfy a given process, a given profit margin. Whilst value engineering is what I was saying there, where you are constantly thinking of how to only give the client what it is they need, saying to improve, to cut off all costs that don't add value to the client. Give the client what value it is they need, and cut out all the other costs that you don't. Kind of similar here, this idea of value enhancement here, where we are adding, if you like, adding value to the product as much as we can. And of course, again, having good standards to benchmark our product next to, so that we can actually see how well we're doing, as opposed to just benchmarking it to budgets, which are internal and might be skewed, but benching it to outside products out there, um, and see how they are doing. So yeah, that is fundamentally what's going on with that chapter. It's a reading chapter. You want to read through it quickly, do some of the TYUs there, um, and jump into the exam kit and start plowing through and putting some answers together. Cool, great stuff. So that is the thank you for bearing with me. That is the end of chapter 9. Awesome.